everyone, and welcome. Thank you for coming. This is our first and initial AMA with Will Remor from the Real World Finance Core Unit here at MakerDAO. And we wanted to have this call today to give them an opportunity to express some of the more complicated side of what the Real World Finance team is up to, and give the community a chance to reach out and ask all of their questions and learn a little bit more themselves. So without further ado, Will, if you wouldn't mind, start with your background and how you got into real world finance in general.
Thanks for having me. Thanks, Jerry and Seth for organizing this call. I'm really excited about being here with everyone. So just actually kind of, I think it's important to cover a little bit like how I get to come to this area, and why I think kind of like it was a little bit like relevant and also like almost like a natural path in the career to get involved in specific into the real world assets and real world finance team for Maker. So my background, originally I came from like a banking background, so traditional commercial banking background in credit risk. So it started with essentially kind of implementing a bunch of like different modeling and in banking across New Zealand and Australia. So that's where I'm based. I'm based in New Zealand, and then after a few years working with the data science teams within banking, I moved on through an opportunity actually to work with a smart contract auditing firm. And that was really exciting because it was around like 2017, 2018, started actually getting into the low level Ethereum stuff. And we worked with some interesting projects back then, like T0, like Shapeshift, and so on. And some of them were exploring already the early stages of securitization. And then from there on, I kind of like after a couple of years working on like low level engineering stuff with a very smart group of people, say, okay, now I got like this background in analytics and credit risk, and got like now this low level Ethereum stuff. What's kind of like next? And I started kind of like essentially like browsing for teams around the world, really, saying, okay, what team is kind of can be a really interesting project to work with that actually mixes at the same time this like the smart contract infrastructure that I've been working now for a couple of years, and actually credit risk. And essentially back in 2019, when I actually got in touch with the guys from the risk team, was actually only Maker was the only answer that I had to that. And then actually started actually kind of engaging with them, Cyrus, and I think Primus as well was really involved there, and started to say, okay, how can I actually work with you guys? And they basically said, hey, actually, we usually have people that actually come from a credit risk or risk background or portfolio management background, and you have, or on the other side, people that actually come from a smart contracts or developer background. But we have no one that actually can talk both languages. So welcome, let's start working together. So that's kind of like how it started, and then started actually working initially with the risk team. I think I was the third person after. So there was actually Primoz and Marco, and then there was Cyrus, and then I started working with the three of them, and then we got onboarding a few of that in that transition of the single collateral DAI to multi collateral DAI initially, and then did a few stuff there with the team, and then about 10 months or so back. There was this dude, Sebastian, that started like, beating the drums about, real world assets and things. And I said, actually, this was really part of the initial conversations that I had with Cyrus at some point. Say like, hey, let's leverage your, credit risk banking background, and let's move into this field. So like, okay, so now we have a team. So let's jump on. And I started actually kind of, shifting between like I think like 40% of my time was actually dedicated to real world assets, and then the rest with the crypto native risk team. And then that became a thing, and here we are essentially.
Speaking of the team, in terms of the composition and stuff, like what is the actual layout? How do you guys like structure the team as real world finance?
Okay. Yeah. So originally it was Seb, so Seb and myself, and we were doing a lot of the R&D into the platform and how we can actually use the Maker existing platform and ecosystem actually to go into real world finance, real world assets, and then we got a couple of people actually interested from the community that wanted to that had some experience in specific, verticals of real world assets like real estate investing or farmland and so on. And then they started actually kind of reaching out to us. And then we kind of say, okay, cool, you've got like some experience. And then that's when we originally onboarded Phil. Phil that's been still contributing and helping a lot. So we work a lot together. And then James, and then at some point there we started kind of say, okay, we've now been talking about like real world assets mostly, but there's also another aspect of it, which is the whole kind of liquidity and treasury of the DAO. And that's when because Seb has got like an accounting background, so we started kind of like exploring those things, and then they say, okay, so now maybe let's start looking at like the different kind of like financial statements of the DAO. Let's start looking at the different like valuations for MKR, because we have actually to provide them that feedback as well. And then there's Mark, I think, that actually started joining and doing some modeling around the evaluation of MKR. So then we had me, Seb as full time, and then a couple of other part-time contributors. And more recently, because of one of the projects on project finance for solar farms, we had also like Christian, that is a lawyer that is a part-time contributor to the team. So it's kind of like shaping up organically over time, and it's actually serving quite well, because it's kind of like we go based on needs rather than like having a full-blown like strategy from the start and kind of like deploying that. I think things around the strategy are now starting to become a little bit more important, but in the initial stages, because it was still a little bit of kind of like a mini startup innovation inside of Maker, trying to make things work, it was much more organic.
Okay, in terms of that organic, is that kind of based in the scalability of real world finance and like trying to grow properly?
Yeah, because I think that's a very it's very different actually from crypto native assets, right? Because on the crypto native assets, you're dealing with different types of risk, mostly market and liquidity risk, essentially, because of the way that the Maker ecosystem is set up and the Maker smart contracts are set up, and the way that the parameters actually are set up to be very over collateralized. So you don't deal so much with operational and credit risks, and even like legal risks. So these things are much more important when you go into real world assets than they are in the crypto native. You still have some operational risk when you start kind of onboarding projects like USDT and USDC and how those networks they work, but they are, I guess, is smaller to the extent that when you have like actual counterparties in the real world that you have to look at, and not only kind of trustless smart contracts. So that organic evolution was to say, let's try to, like, I think Matthew was mentioning this the other day, and I found a very good analogy. It was, let's start to kind of like to crawl before we can, walk, and then we can run. because we need to set up that base of confidence and trust with the community, and get as much feedback and input from the community as we can to answer those questions properly as we evolve before going into hundreds of millions or even like $billion kind of investments, right?
Scale safely for sure.
Exactly. Yeah.
So also we keep kind of going back and forth on this too. So can you explain a little bit of the differences between real world finance and real world assets?
It's usually kind of, we've been talking a lot with people that are from a known crypto background. So that's kind of it's teaching us a lot of how to use analogy to explain some things. And this is important because, it's very easy kind of to talk to other people that are being in the crypto ecosystem. And usually you talk the same language and you go straight into jargon. And then people say, yeah, okay, of course I understand what you're talking about. But when you're actually growing, if you're going across that wall of crypto to the rest of the world, you've got to use analogy to start actually to talk to people, right? Because otherwise it's just going to be that blocker of this guy keeps throwing me jargon after jargon after jargon. I have no idea what he's talking about. And I get that a lot, even when we're talking with asset originators, right? So we're starting to work a lot on that analogy. And why is it important, to mention in the context of your question? It's because sometimes it's challenging to kind of put what the Maker credit system is in relation to an existing, say, institution on the real world, right? So there's aspects of Maker that actually work like a decentralized central bank, you could say. And then there is aspects of Maker that actually can fit more into an investment bank, or even to some extent into a commercial bank type of thing. But if you take a commercial bank type of aspect, like a commercial bank, and that's my background in commercial bank, you usually have a few core areas of that, and two very important actually areas. One that is actually related to finance, and one that is related to risk. The one that is related to finance usually actually associated with treasury and finance. So these are the guys that actually manage, balance sheet, liquidity, profitability for the bank. And these are mostly people that are coming from an accounting background, have CFA type of certification and so on. And on the other side, the other big group of what a commercial bank or a new investment bank to an extent actually does, it's kind of risk management, right? And essentially the real world finance team is actually doing both at the moment. We're very small, but that's actually we're doing both, looking at liquidity balance sheets, financial statements on the side, so more a treasury finance side of things. And on the other side, doing risk management, so due diligence and so on, which is kind of all of the real world assets type of thing. We're kind of engaging with funds and asset originators, and then kind of explaining to them the process of due diligence that we are doing on them and so on. So it's kind of it's a very small team, but it's actually, if you compare that to what an investment or commercial bank would do, it's a lot. But we're just at the beginning. So there will be lots of things actually to cover along our journey.
Very much. Peyton, did you want to ask your question?
Yeah, I'd be down. I need that video doesn't really matter, but was curious, Will. Obviously, with crypto native assets, it's very easy for the community to kind of dig in and see all there is to see, whether on the blockchain or through other cool tools we have online. But with a lot of real world asset deals, there's NDAs, there's mesa contracts, there's all sorts of things that you not want to make public right away. So I was curious to hear your thoughts in terms of balancing that with, the need for transparency within the DAO, but also for the ability to close deals with our partners.
Yeah, that's definitely like there's two pieces to that. So I think one piece of that is around as much is actually guaranteeing as much transparency as as our obligations within the team actually allow us to do, right? So because we still got like those, as was saying, like the NDAs and so on that are signed to be able actually to look into deep into the things that are happening within within the funds or the asset originators, to be able actually to provide, to be like the conduit that provides that information to the rest of the community. So there's actually the education piece, and there's also the education piece with the asset originators and the funds as well, because we have to manage them, even if some of them actually are too protective of some pieces of information that we uncover through the due diligence process. Sometimes we're actually on the balancing act where we have actually to say, okay, you can be potentially secretive, but you cannot be too secretive, because otherwise you don't actually bring the trust of the community out there. And we need actually to make sure that we actually can provide them as much information as it's reasonable for them actually to make an informed decision on whether actually to invest into this particular asset or groups of assets that you have here or not, right? So there's actually that education piece. The other piece is actually from the team to the rest of the DAO is the transparency aspect, right? So we make like huge efforts to be as transparent as possible, not only in terms of the process of how we deal with things, but also in terms of the information that we can actually collect, that we can transfer on to the DAO, for the DAO actually to be able to make those informed decisions. And in particular, and most importantly for investments from the MKR token holders that essentially kind of vote on the parameters and vote on the onboarding of those different asset originators and funds, that we can have the transparency on the risks. What are actually the core risks that exist on onboarding each of those, and actually how can you kind of like summarize that in a clear and and proactive way to the MKR token holders, so they actually can make those informed decisions. So all those aspects is kind of like efforts, and we're in that world where we're mostly dealing with like real world assets that actually link to on the other side of that wall between between the crypto ecosystem and the rest of the world. I think at some point we're going to probably start seeing some of the debt that is going to be raised as well on chain. That they are related to off-chain aspects. There are a few projects already kind of like working in that, and I think we're going to see, and then it will allow the ecosystem to have as well some trust through looking at how those smart contracts are working. But we're not there yet. It will take still some time, I think.
I just want to say real quick also, if anybody does have questions at any point, feel free to come in and ask. You're always welcome. What kind of limits do you think are reasonable for a DAO to set in terms of onboarding real world assets versus more crypto native collaterals?
Yeah, I think it will there will be a few limits, because there are challenges, right? There are challenges with just the due diligence process and actually and kind of like educating the partners, but also like there are challenges that are more like I guess technological challenges, and of course like operational and risk challenges that we have to cover, right, for scaling. So the crawling to running thing. So I think at this stage we're kind of aiming to have, okay, if we could have, say, at some point 10% of the portfolio invested into it, into real world assets, that would be already kind of like a pretty huge sign. We're not there yet, and it's going to take some time for us to get to that like 10% of the portfolio. Why 10%? I think mostly I tend to look at things like really from a risk perspective, right? And when you look at things like from a risk perspective, you tend to look at not the episodes of like bull runs and fast growth as your parameter for analysis, but the crashes. That's your parameter for is risk. People look at things from the loss perspective. But they don't look at like excitement of like we're going. So I think in this in this aspect, I think I always take kind of snapshots of what happens to our ecosystem after something like the corrections that we've seen over the last month or so, and the corrections that we had back in early 2020 in March after the market corrected by like 60% or so. And when you take those snapshots and you take actually the balance sheet of the snapshot of the balance sheet at that point in time, you actually see that there is a very high correlation between crypto native assets, right? So we have 30 years so collaterals in our ecosystem, but effectively during those events, you see that effectively what you do is you have three. You have versions of Bitcoin, you have Ether, and you have stable coins. And the rest is very minimal because actually they are very highly correlated assets to each other. So actually at any point in time that when there is actually a correction, we're always gonna, in the foreseeable future, go back to that version of our balance sheet. That's actually kind of our real version of balance sheets. And that gave me like really kind of an insight to say, if in the next correction that will happen, regardless of whether we're going to go again back into a bull run position or not, and we correct again by say 50 or 60%, it would be really nice to see, okay, now our balance sheet has shifted slightly. It's not only, all of those correlated assets and ETH, Bitcoin, and stablecoin, but there's also like some real world assets in there that actually have kind of buffered the protocol. And then at each stage of the evolution, if we can get a little bit more of that, we're going to be in a much more robust position than where we started off. That's how I see things. So whether the figure be 5 or 10% of the portfolio, it's a challenge and will be a technological challenge that we have to solve along the way. But the composition of the balance sheet is what actually really I think we should kind of be mindful of if we want to one day make actually an ecosystem that will go beyond the side of the wall that is just crypto for crypto people, but also go and talk to the people that are on the other side of that wall and say, okay, actually, this ecosystem can really scale to a global level.
Mardo, did you want to ask the question?
Hey guys, thanks for having this. I'm just getting up to speed on MakerDAO, and I'll just give a few seconds on my background. I work at AllianceBernstein at a private credit fund. We lend to private equity-backed companies, also doing equity co-investments and lending in the venture space too. And really excited the stuff that you guys are doing here and trying to bridge the real world assets and bringing it on chain. I had one question. How do you guys think about taking action on the collateral if there's a default? And I'm just coming up to speed, right? I think the one real world asset I see is I think the mortgages that Maker is lending against. If there's a default there, for example, how do you guys think you would handle taking action for recovery?
Yeah, that's a very good question. Thanks, Marlon, for asking that. So that's one of the reasons as well that scalability is going to take actually some time for us. I think in terms of the real world assets, because when people actually working in the crypto native and actually the way that actually the DAO was designed to work, the Maker credit system, you have that ecosystem of that actually that assist the protocol, maintaining the protocol and the liquidity of the protocol by actually buying off the assets in cases of liquidation, right? So the liquidation are mostly handled like automatically or semi-automatically by profitable incentives to that keeper ecosystem, which is kind of like in the real world, is like the debt collectors of the real world. In the case of real world assets, of course, the processes are much different, right? So a mortgage foreclosure or a mortgage kind of collections recovery foreclosure takes longer, right? Takes longer. So we have to take into account that those processes are going to be happening in the real world. The way that the protocol currently buffers against that is through what we call in structured finance over collateralization and credit enhancements. And these are the discussions that we have with asset originators and funds to make sure that Maker doesn't take junior position into those structures and doesn't and also has a reasonable level of credit enhancements, meaning here that that junior portion of the structure is high enough for us to be able to sustain a reasonable level of defaults. And the reasonable level of defaults there is not going to be like a silver bullet across all of the different asset classes. Different asset classes, they have different probabilities of default. So whenever we assess the structure, we need to take into account what in the economic cycle of a particular asset class is, and what is the default rates for those asset classes. And when we do that, we price that in. We say, okay, cool. Even if there's actually collections and recoveries that actually needs to happen in the real world, the probability of the Maker ecosystem actually losing from that pool of assets is very, very low, because you would have, for example, probability of defaults for real estate are historically for the last 100 years or so, they have been below 1%, and only a few blips along the way have spiked. So, for example, during the GFC, I work in a bank, so I was actually looking at all of those, all of those metrics, like pretty much like monthly. During the GFC, we had a spike of like 5-7% during a few months. Then we have to make sure that actually the structure we have buffer for those stress case scenarios. And we are still during our journey within the team, I'm actually currently spending a significant amount of time into bringing some of the tooling to do some of those stress test scenarios, so that actually we become, even better at putting all of those credit enhancements in place, so that the protocol actually doesn't lose, because we always in the safest position of those structures as well. I don't know if Mado, this answer your question. I may have gone into a couple of tangents in there, but hopefully that's how we say things.
Yeah, no, that's very helpful. Thank you. I would just have one follow-up, is that, and if the scenario of the default happens, what's the infrastructure to collect or liquidate? Is it the junior piece that's, let's say, initiating the foreclosure, talking to counsel, et cetera, or is a real world finance team the one who's engaging with lawyers to take action and put the property in foreclosure, et cetera?
Okay, so on the real world side of things, so not on the protocol side of things, you still have the debt being serviced, and the asset originators and the debt being serviced there, right? So those services of the debt, we make sure when we do that structure that they have proper processes for collections and recoveries of the debt, right? So it's just that the recovery of the debt will take longer than you would take on a crypto native. In a crypto native, it's a matter of hours. on a real world asset, for like a house, can potentially take, weeks or months actually for the foreclosure actually to go through. And there might be like some legal processes in terms of like, court filings and so on that have to be taken into account. So what we focus our review is on actually making sure that the process on the servicer is actually in place, is properly in place, and that they have some track record of having already gone through that. And that's what gives us like the certainty that, okay, if there is actually a recovery that needs to happen here on this particular piece of that, they have the experience to do this. And if they don't, that when we review the structure, we can assign a backup servicer that can do that job on their behalf. That's how we make sure that we tied the different screws. So this is kind of like, it's a mix between compliance operational things that we put in place in terms of as part of our due diligence process.
We had a question from Max. Max, did you want to speak?
Yeah, absolutely. So I'm an MKR holder, and I've worked in real estate for about a decade, and I'm really curious about this intersection. And so in my experience, there's this robust and competitive ecosystem of financing you can get in real estate. And so I'm curious why I'm curious if there's an adverse selection problem, essentially, that only crappy assets that can't get cheap financing in the real, using traditional channels are going to go to MKR or to Maker. So that's what I'm curious about. What sort of collateral do you think you're going to get? Will it be good stuff, or is it going to be junk?
It's absolutely actually important question, because it's one that we are very mindful of. So there's a part of it that is a matter of how competitive we can be, right, to other say investment banks, and that competitiveness is a matter of cost of capital. It's important. Like, the cost of capital is our cost of capital lesser than the cost of capital of, for example, other investment banks or even commercial banks that actually are structuring and investing into those assets. It's a consideration. But the other consideration, and I think that's one that is really important as a community for us to consider, is the consideration of process. Is our process leaner and easier to deal with than the process of actually investment banks, for example? So, for example, when an investment bank starts working with a real-world asset actually partner, will they take 6 to 12 months from the moment that they engage that partner to work on, say, a warehousing facility, or can actually they do that in, say, 3-4 months from the period of engagement to the period of investment? And so, I guess depending on how we're answering those two questions, we will be able to answer your question next around, can we get better on bringing better risk profiles into the protocol rather than only getting early stage startups that anyways cannot get good financing conditions in the real world. That's why they are coming to the protocol. So this is something that we are really kind of mindful of, because when we started actually real assets team, of course, we are not known, like Maker is not known as a protocol globally or even in the US for doing this kinds of investments. So there is a part of it that is actually knowledge, but like to the outside world, but the part of it that is also about, okay, are we painful or are we easy to deal with? And then our cost of capital, is it better, or at least it matches the cost of capital of our competitors for a similar risk profile? And these are all things actually we are constantly covering and actually reviewing even internally in the team, saying, and working even with our essentially our stakeholders in the governance team around, can we actually tidy up processes here so that actually the governance process is leaner, so that we can move things along faster in terms of the process, but also can we make sure that we have proper engagements early on in the process with the part of the maker ecosystem that is more like a technology part. So our partners in terms of the smart contracts team actually needs to do their assessment on the smart contracts that we're putting into the ecosystem, and our partners in the Oracle's team that are doing a great job, and they are right to ask us the questions in terms of the valuations of the assets, because they need to trust that the valuations of the assets they're investing in is what actually the asset originators or our counterparties actually say they are. So all of those things are actually important considerations that usually our, say, competitors in the real world, they don't necessarily have to do, because they have already all of those plugged in, because they already engage data brokers on real estate that know exactly what the valuations are. They have all of those technology integrations already built in, and therefore we have several moving parts that we have to consider to be able to get good risk profiles into the protocol. And in the initial stages was mostly like startups, and now we're say, okay, how can we actually move up in the risk profile of the things that we're gonna bring to the protocol. And moving up in that risk profile, those institutions, because if you move up, you're attracting institutions that are used to working with structured finance, and therefore can we actually work with them on the same level playing field of an investment bank? And all of those things require us actually to be able to talk those same words with our internal partners within the community. And when the community understand that these are very important considerations, they start taking that into account and say, actually, we have really to improve our processes. We really have to look at this thing from an honest viewpoint and improve everything that we do, so that we can be on the same level playing field as, say, Goldman Sachs or Deutsche Bank, because otherwise we're only going to attract companies that cannot get financing in the real world. They will be attracted to Maker. That's really a really important consideration. Thanks for asking the question, Max, because we've been discussing that a lot recently.
Yeah, thanks. And just a question that's almost like the flip side, which is that is there something that Maker or crypto in general can offer a borrower? Let's say I'm a borrower that is unique and special, that doesn't exist in the traditional finance world. Something that's going to make this type of financing really disruptive.
I think there are, but I guess the maturity of that part of the ecosystem is still not there yet. So one example, which is inherent in the way that smart contracts are built as a primitive, is the fact that you have the programmability, right? So if you have collaterals that actually are in the Maker ecosystem that represent fixed income assets in the real world, all of a sudden you open up a huge field of opportunity for some of those companies, not only the asset originators, but other people that actually want to invest into fixed income, to engage into the innovation that smart contracts allowed for the crypto ecosystem, but for fixed income assets. Right now, we don't have that yet. And I think it's not only crypto that is moving into that direction. We have companies in the real world, like the Robin Hoods and Betterments and so on of the world, that are also going to be exploring the fixed income opportunity in the next decade, in my view, because they've kind of democratized the extension of equity. So now fixed income is probably the next realm for them. So I think giving that aspect of programmability for this, it will be at some point an opportunity that will move, but it's just not there yet in terms of the evolution of the ecosystem. But that's a promise, I think.
Awesome. Thanks a lot.
I was kind of wondering, so do we work with any financial organizations that lend fiat currency using DAI as collateral?
Not at this stage. At this stage, most of the originators that we are working with, they are using DAI as a wholesale currency, right? So it's mostly the back end thing, and their borrowers, their obligors, they don't see DAI as the currency with the liquidity that they want to interact with in the real world. Saying that, we had at least one of the asset originators that we interacted with in the last batch of assessments of due diligence, that were saying, hey, some of my obligors, some of my borrowers, they're starting to say that because DAI doesn't have necessarily to go through a lot of the painful kind of on-ramping and off-ramping that we have to do, they're willing to accept DAI as the payment for as the way of getting their funds and actually of paying their funds back to us. So this is the case that I think can be quite valuable in the future for trade finance. So because trade finance is an asset class that trades where the debt is denominated in US dollars. So for them, it's probably going to be a little bit of like a long hanging fruit. And these asset originators are saying, hey, my buyers and my sellers, they're actually accepting DAI. They're starting to accept DAI as the vehicle for receiving. So I think that could be the initial, they just a beginning of a change that might operate for other originators in the future. But this is still at the very early stages.
Does that kind of give an example for how real world assets kind of help the liquidity of DAI globally?
Yes, that would be also the case. I think on a global scale, we've got some low hanging fruits for the reach of DAI. Right now, pretty much all of our asset originators are based in the US. We have a couple of exceptions. So it's because DAI, because DAI is pegged to the US dollar. So the majority of the funds and asset originators will accept DAI in the US. But because of the way the platform is set up, we can really be a global platform, not only limited to any jurisdiction. That's the whole promise of crypto at the end of the day, right? So the low-hanging fruit there is definitely trade finance, because that is denominated in US dollars, and DAI being a soft peg to the US dollar, it makes things easier. Saying that, it's not necessarily the only case. We've got the challenges if we want to extend DAI to a global scale, which is you have then to deal with asset originators and funds that are sophisticated enough so that actually they can manage liquidity through a hedging facility for DAI to whatever other currency, and of course the local jurisdiction challenges that they may have to get through. So they need to be into jurisdictions that are mostly crypto friendly, because it's easier for them to deal with already like a counterparty where the acceptance of funds in DAI would actually be a cost for them to operate with us because they're not in, for example, like a sandbox where they can actually deal with money transmission in crypto assets. So that's always a consideration that we have to be very mindful of from the team's perspective into what are the jurisdictions where we can operate safely, and that won't actually kind of hamper our innovation and hamper our progression. So at the moment, like the US is the main one, but I think there are other jurisdictions across the globe that are very that created like very interesting sandboxes for us to operate. But we have to manage that with sophisticated institutions that actually can manage the hedge, unless we are dealing in the trade finance space.
Hey, Will, and following up on that, expanding into different parts of the world, since I know you're in way out there compared to me, and Sebastian is in Europe, somewhere in Europe. Is your team, the RWF team, looking to maybe add someone who might have some experience as a former mortgage chief or head of international credit, or maybe securitized products, things of that nature? You guys looking to add somebody in the US that has that experience? How are you thinking about that, adding more help?
Yeah, I think Frank and Seb is in the call as well. Seb, feel free to actually to jump in. For this one, again, this is being mostly kind of like an organic evolution of the team. So based on the needs that we have from the deals that we are covering, we are adding people in the team with the required experience to cover specific aspects of the debt. So I think this is definitely an area that we can explore a little bit more, but it's being mostly organic. At the moment, we are starting to organize a little bit more in terms of like the framework and the strategy of how we want to progress post this first number of collaterals that we've got in our backlogs to assess. And I think some of those, some of the due diligence that we're going to be doing on those might require people with specific verticals of experience to be brought into the team. But at the moment, it's mostly organic.
Got it. And when it comes to dealing with real estate or any kind of RWA collateral, is it different when it comes to liquidating something in New Zealand versus Hong Kong or say Peru or even Miami, Florida? I mean, what's the difference there? Do you guys have an idea?
Could be, there could be some significant differences. So depending, I think there will be like some overarching legal frameworks across the globe that we need to cover. So for example, just to give you an example, if you're working with countries that are part of, say, the ex or current Commonwealth of nations, so say New Zealand, Canada, Australia, Singapore, Malaysia, and so on, they have some bases of the law that are very similar. At the base level, we're going to get some very common frameworks. But if you extend beyond that, then it does require a little bit more of an understanding of the local jurisdiction for dealing with liquidation of assets, recovery of assets, right? And understanding how the courts work in those jurisdictions. So I'm not a lawyer, so I cannot necessarily comment on too many of those aspects. I understand quite a bit of how things actually work in the Commonwealth, because I'm part of it. But then, so there is that aspect. And then, of course, there's trust in terms of the property law of the different jurisdictions. So how robust is a particular jurisdiction in terms of property rights? Again, like probably in this case, we're in the very early stage, we're not necessarily looking too much beyond OECD countries, right? So because OECD countries, they have like a number of requirements to enter into the OECD, which means they have, proper privacy and property law that allows them to be in that privileged group of stable, more robust economies. If you go into, I don't know, potentially some countries, and I'm not naming anyone in particular, if you go into some countries in Africa, let's say, then it's probably like a different ballgame, and one that I particularly would say, okay, let's maybe leave the country to be dealt with at a later stage when we have people that actually have knowledge in those jurisdictions to cover, because I don't even know whether they would be easy to liquidate a particular asset, say, I don't know, in Zaire or in some country in Central Africa. So that's kind of like the framework how we would take it.
Understood. Thank you for that input, and very exciting stuff.
Thomas wanted to ask, isn't diversifying away from USD denominated or US based assets important? More fluid, easily transferable assets might be prioritized going forward.
Sorry, can you repeat the question just?
Isn't diversifying away from USD denominated or US based assets important?
I think from a diversification perspective, yes. So the way that I think we can look at diversification from different angles, right? So there's asset class diversification. There's jurisdiction, country diversification. There's economic cycle diversification. So different countries are in different stages of their economic cycles. So very, I think, relevant example of that is, for example, post-COVID, pre-COVID and post-COVID. So in the pre-COVID area, like for example, like Europe and the US, they were going already through the latest inning of their expansion. Well, you had other countries, particularly in Southeast Asia and so on, that were not in the same stage in the economic cycle. And if you're still in a stage of economic cycle of like expansion means, that is created and that is paid because the economies are growing. So in this case here, of course, there's like a strategic and tactic, directions that you might take to say, I really think we should diversify our portfolio away from an economy if the maturities are short, away from an economy that is going towards the later stages of the expansion and more into stage of expansion, because then we can assure that those businesses will be able to pay down their debt. It's just like what we want, right? So I think, but that's more like a macro perspective into the way that actually you invest in that, and at this stage that strategy is not fully laid out. But I definitely agree with the argument of actually extending beyond. But again, that comes with the challenge of local legal jurisdictions for property and liquidations, as we were covering before with Frank, and comes with challenges around maintaining hedging positions. So we need to deal with institutions that have already that experience, or at least that they can engage with the experience, have experience to deal with hedging in those jurisdictions.
Hector was asking if you have any like recommendations in terms of resources to start reading up on real world assets and learning a little more about all of this.
Yeah, definitely. I think for the community, keeping an eye into some of the reports that, for example, global credit ratings agencies that they write on the different assets that we evaluate. It's important, and it can give you like very deep insights into the stages of the cycle that those assets are in. Looking into lots of documentations around the OECD and the different laws that apply, property law for those assets is also important. Having a look as well into the different like jurisdictions and how crypto is looked at onto those different jurisdictions is also very valuable and can give us great inputs. Other than that, I think just studying fixed income, how it works, and how it works, what I call like the different counterparties that are usually involved into those types of structure will actually give us like immense amounts of actually feedback and input of how we can actually continuously improve the things that we do within the team. So if people actually come with all of that kind of background and are reading those things and kind of like continuously giving feedback to us, I think we're going to get lots of value from the community.
Unless there's any further questions from anybody else, I kind of wanted to end on the note of what are the next steps for the real world finance team, and what is the progression going to look like for the next 6 months to a year?
Yeah, I think that's looking super exciting. So we got two main streams of work in terms of like the in the real world asset part. We've got lots of projects actually going into actually structured finance, and it's a few important projects coming through, like project financing, so like the solar farm example and so on. So actually real world assets, I think there's quite a bit to work on that. I think there's also quite a bit still to be done in terms of strategic tactic and strategic decisions around portfolio allocation and how we are going to segment the portfolio going forward, like what are the kind of like the choices that we're going to make and how we're going to engage with the funds and asset originators to make sure that they fit into that portfolio allocation. And we have to do a lot of that communication with the DAO to make sure that the DAO is in agreement with that evolution. So there's aspect of that. On the other spectrum, more like the real world finance things, is putting a lot of transparency into the way that we doing calculations, evaluation of MKR, how the treasury is functioning, how is the DAO kind of financially sustainable from from an expense point of view, and the amount of interest that we are collecting through the surplus buffer. And that's a lot of the work that Seb and Mark are doing at the moment, and making all of that transparent and kind of open for a thoughtful discussion with the community to say, are we getting ahead of ourselves in terms of burning too much money, or are we right here where we are, in having I guess opportunities to discuss that with the team. We've got a lot of that work to do, and one of the core pieces into that phase of getting from crawling to start walking, and that's a lot of the work that is going on at the moment is tidying up all of the different legal structures that we can operate safely in. So this is more like the work for the next between month and 3 months or so. That's the current focus, making sure, okay, we've got like a few asset originators, and we've got to really tie the screws around the loose ends of these structures. And that's what's going on.
Well, thank everybody for coming. Yeah, everybody. Thank you, Will, so much.
Peyton, you're already much cooler, man. It's like, yeah, that last question was the best. Cool. Thank you very much, guys. Yeah, feel free to reach out to me or to anyone in the team. We're more than open, actually, to get more into detail on any of the aspects that we covered today here. And we're gonna keep with Jerry and Seth communicating and opening the forum for the discussions, for thoughtful discussions around all of this. So you guys, feel free to organize any of this. If you want to organize on a specific vertical of the stuff that we are doing in the future, reach out. If you want to go, I don't know, real estate, farmland, solar farms, or whatever, we can actually go into a deeper dive on many of those verticals with you.
Absolutely, that sounds fantastic. And since this is going up on public channels, where can people reach out to you?
I'm across most, social media, so can reach out to me on Twitter, can reach out to me on LinkedIn, and reach out to me on Rocket Chat or in the Maker forums. So that's usually where I'm always keep an eye on the pulse there.
Well, thank you so much again, Will. This was fantastic, and thank you everybody for coming.
Well, thank you everyone for your thoughtful questions, and hope to talk to all of you soon.